A company might have carried out an investment appraisal to look at the viability of those investments. And the company may not have sufficient funds to finance that investment. If this is the case, the finance manager may want to source for fund for financing the investments. And what are those sources that are available for a company to finance its projects? So sources of fund, let's look at the definition of sources of finance. It deals with the way companies are funded. Company can raise funds through short-term or long-term sources. Short-term sources of finance. The short-term sources of finance are used to fund short-term funding gaps. They are basically needed for the day-to-day operation of a company or business. So in the short term, we are looking at a period not exceeding 1 year. How do you fund your operation? Short-term sources of finance deals basically with operations, financing of your working capital, your account payables, short-term maybe payment of salaries. Let's say as a finance manager, you do your monthly cash flow projection. And after you've done the projection, you realize that the inflow is less than the outflow. Means that there's going to be a negative cash flow. So how do you fund the gap? What are the sources of funds that are available for you as a finance manager to cover up the short-term funding gap to ensure that operation is not disrupted? So what are those sources that are available? The first is bank overdraft. Bank overdraft. It is, what is it? It's a temporary arrangement with a bank which permits a company to withdraw more than its available balance from its current deposits account up to a certain limit. So I want you to take note of this word, up to a certain limit. That means you cannot withdraw the account or overdraw your account beyond a particular limit. The overdraft is granted against security. That's another thing you need to take note of. This facility is usually arranged for a period of time not exceeding 1 year. Interest are charged on excess drawings. So let me explain how the bank overdraft works. It's just like your short-term loan. You write a letter to the bank applying for that facility. And the bank grants you the facility. For instance, maybe the bank overdraft is for 500 million. That's the limit. It means that you cannot overdraw your account beyond 500 million naira. At the facility, you have to present a collateral to be able to access that facility. And also, we said interest is charged on excess drawings. So if it is 500 million, you cannot be charged 500 million, or you will not be charged 500 million on a flat rate. The charge will be based on your closing balance at the end of the day. We'll look at the calculation shortly, but it's not a flat rate. It's whatever you use, you pay interest on whatever you've used out of the 500 million facility that has been granted. And this type of source of finance is very good for a trading business, in the sense that you pay out money from the bank or from the account, and customer pay in money. So the balance in that account fluctuates up, down. So it's not a fixed, you will not be paying interest at a fixed rate, 500 million. No, it will be based on your closing balance for that day. So what are the advantages of bank overdraft? Number one, it is flexible. Number two, it is renewable. Number three, it is a cheap source of debt financing. Flexible in the sense that the interest rate is not static. It is renewable at the end of every year. You can roll over, you can renew the overdraft facility, and it is cheap if it is used properly. The second source of finance is trade credit. What is trade credit? Trade credit is a facility that allows a company to purchase goods and defer payment to a later date based on the terms of credit given by the supplier. It is a dominant part of accounts payable. It appears as sundry creditor on the statement of financial position. Trade credit is a cheap source of finance than the institutional source. So how does the trade credit work? You buy goods today and you defer payments to a later date. So most companies have what we call terms of trade. The terms of trade will be stated on the either purchase order or the invoice, as the case may be, allowing maybe a 30 days payment term, or it may be 45 days or 60 days. So 30 days payment terms means that after the goods is supplied, the supplier is expected to be paid after 30 days of delivery. So this is another way a company can finance its operation. Instead of borrowing money from the bank to purchase the products, you can easily arrange for trade credit with a supplier. And also, there's also a credit limit also as regards trade credit, depending on the terms of trade agreed with the supplier. The supplier may give you a credit limit of, say, 2 million, 5 million, 500 million, which means that you cannot purchase at each given point in time rather, you cannot go beyond the credit limit. So what are the advantages of trade credit? Number one, easy availability. It is easy to access, unlike the institutional credits. Number two, it is flexible. Number three, informality. Majority of the trade credits, they are not as formal as the institutional credits, though there are some other some suppliers that may need you to sign one or two things, one or two documents. Some suppliers may even require a BG, a bank guarantee. Trade credit seems to be costly as it does not involve any explicit interest charge, but it involves implicit costs, such as loss of cash discount. Also, the suppliers may just add a little markup to the goods supplied. At times when you go to the open market to buy some of those goods, you buy them at a cheaper rate than buying from a supplier. So, but you won't see a charge on the invoice that interest is 10% or 15%, but at times there may be some markup on the invoice. So the interest rate is not explicit, something that you see clearly, but there may be some additional charge on it. The third source of finance is short-term loan. You have a short-term funding gap and you've looked at the alternatives. Do I go with bank overdraft, trade credit, or short-term loan? So what is the short-term loan? This is a loan for a specific amount, for a specific period of time, not exceeding 1 year, at an agreed interest rate. The main disadvantage is that the main advantage, sorry, is that payment is not on demand. Okay, so for the bank overdraft, payment for bank overdraft is basically on demand. The bank will just give you a 7 days notice and request that the facility be liquidated. But the main disadvantage of the short-term loan is that interest is fixed. It is not based on what you have used. If you borrowed a loan of 200 million at 20%, whether you use the money or you don't use the money, you are going to pay interest rates at that 20%. But for a bank overdraft, you pay interest based on what you have used, not on the facility amounts. Okay, so let's look at the next one, factoring. The book debts may be assigned. Now, factoring is talking about a situation where a company wants to sell its account receivable to an agent. So the agent will be the one that will go after the debtors to collect the money. So the book debts may be assigned to a bank and cash realized in advance from the bank. Thus, the responsibility of collecting the debtor's balance is taken over by the bank on payment of a specified charge by the company. So the company will also pay for that agency services. This method of raising short-term finance is known as factoring. So there are two types of factoring. Basically, we have the recourse factoring. This is a situation where the company retains the risk of customers' defaults, but also continues to maintain relationship with the customer. Here, the company retains the risk in as much as the debt has been sold to the factor, but the company will still be the one to bear the risk if eventually the customer fail to pay. The non-recourse factor, the factor accepts the risk of non-repayment by the customer. So if it is a non-recourse, whether the customer pays or not, the risk lies with the factor. Discounting of bills or invoice. This is another way of financing a company's operation. Let's assume that you've invoiced your customer and the credit term there is 40 days, 30 days, or 25 days. And there's a need for funding. You may decide to sell that invoice to a bank that's this amount of money, bill discounting. This is another form of financing your trade. Bill discounting. This is another way of financing your short-term activity. When goods are sold to customer, it's expected that there's a credit term, maybe 30 days, 40 days, as the case may be. But if the company cannot wait till that term, the company may decide to discount that invoice or bill with a commercial bank and receive payment in advance. However, the company is going to pay an amount that is called a discount to the bank for financing the projects or financing its operation or for buying over the invoice. So these are basically the sources of short-term finance that is available to a company in running its operation. Okay, so let's look at the way the bank overdraft works. A company has a facility of 500 million. Interest is charged at the rate of 20%. We have 365 days in a year. So the bank overdraft is charged basically on a daily basis based on the end of day balance. So what will be the daily interest rate? It will be 1 divided by 12. Sorry, 1 divided by 365, 1 divided by this times the interest rates. So this will be the daily interest rates. Okay, so let's look at the bank statement here. At the beginning of the day, the company opened with a negative balance of 424 million. So we assume that the previous day interest will be based on 424 million. So the previous day, this 30th of April 2023, the previous day will be 29th of April 2023. So let's see what the interest will be for the 29th of April, which will be equal the closing balance of this amount times the daily interest rate, 232,000. On 30th of April, the company opened with that amount, but there was additional withdrawal of 40 million. The overdrawn balance has increased to 464 million. So what will be the closing balance? The closing interest rate will be based on closing balance. Okay, that's not the closing balance. So still on 30th of April, there was a transaction and inflow of 40 million, which reduced the closing balance to 424, back to what it was at the beginning of the day. So daily interest rate times your closing balance. So the same as if that of the previous day. On May 1, there was a withdrawal of 48 million. Excuse me, there was a withdrawal of 48 million. And there was an inflow of 250 million from a customer. Closing balance is 222 million. So interest will be based on this amount days multiplied by the daily interest rate, which gives 122. So if you look at what's happening here, if there's an inflow, the interest for that day reduces if the inflow is more than the outflow. So if you look at the balance is fluctuating from 400 as at on 1st May, the closing balance was 222. So for the month, the interest will be the sum of all the daily interest charge for the month. So we said one of the advantage of the bank overdraft is that it's based on withdrawal. But let's assume that this facility is a term loan. If this is a term loan, the company will be paying interest based on this 500 million, whether it is being used or not. So if it is a term loan, let's see what the interest will be like, the daily interest rate. It will just be, okay, equal 500 times this amount. So the daily interest rate will have been 273. That's against this fluctuation here, 232, 232, 122. So you pay more if it's a term loan, whether the company uses the facility or not. But for the bank overdraft, there's this flexibility. You charge interest is charged basically on your end of day balance. So that's just one of the advantages of bank overdraft over a term loan. So thank you for watching today's video. Do like and share